Welcome to The Money Dove, a channel all about stocks, options, investing, and financial decisions to embark on a journey towards financial freedom. Be sure to like and subscribe. The S&P 500, the holy grail of the U.S. stocks market. It is by far one of the most commonly used benchmarks, which most fund managers are compared against. Here's a table showing the various market index with the number of underlying constituents, market capitalization, and their 20 years annualized returns. We could see that the S&P 500 has a market capitalization that is more than 70% of the MSCI World Index, despite only having 500 underlying constituents, compared to close to 1,400 constituents in the MSCI World Index. More than just having a sizable market capitalization, the S&P 500 also managed to outperform most other broad-based market indexes over the longer run, resulting in the S&P 500 outperforming the MSCI World Index. Beating the S&P 500 consistently is a badge of honor only the best fund managers could have. As a matter of fact, studies have shown that in most years, only a minority of active fund managers manage to outperform the S&P 500. The number further reduces if we account for consistency. To make matters worse, fund managers charge high fees that eat into the returns. After accounting for fees, only about 10% of active fund managers outperform the S&P 500. What if I told you that beating the S&P 500 is actually extremely easy and it does not require in-depth knowledge of the market? Sounds too good to be true? Make sure to watch till the end and decide for yourself. Before we dive into the strategy, let's understand the S&P 500 and why it is so difficult to beat it or outperform it. The S&P 500 is a stock market index that tracks the performance of 500 large companies listed on U.S. stock exchanges. It consists of big names like Microsoft, Google, Tesla, Ford, Citibank, Visa, Coca-Cola, McDonald's, Costco, ExxonMobil, Disney, or even the recent AI darling, NVIDIA. As you can see, the S&P 500 is well diversified across sectors and represents a significant portion of the publicly listed stocks market, making up about 80% of the total value of all publicly traded stocks in the United States. Because of this, the performance of the S&P 500 is a good indicator of how the overall or aggregate listed equities market in the United States is performing. Due to its significance, the S&P 500 is also often used as a benchmark for many financial instruments. For example, the risk of many assets in the United States is often measured according to their correlation to the S&P 500. If the S&P 500 performed so splendidly, how do we propose to beat the index consistently then? There are many ways of beating the S&P 500 with varying degree of risk taken. However, the strategy we're going to share in this video is relatively simple, safe, and conservative. Our answer lies in the use of options. Now, many of you would probably gasp at the mention of options. You must be screaming in your head, options? Relatively conservative? They must be kidding. For audiences unfamiliar with options, you can check out our other videos on options that we would share in our channel. Here is a quick recap of put options, which is relevant to our strategy. If someone pays a premium and buys a put option, he or she is buying an insurance or guarantee from the seller of the option. The seller guarantees that if the underlying stock or ETF falls below a certain level, the buyer or holder of the put option could sell the underlying stock or ETF at a predetermined price level. This predetermined price is also known as the strike price. In the event that the price of the underlying stock or ETF is above the strike price of the put option contract, the put option expired worthless. The seller of the put option contract then gets to keep the premium they collected without having to fulfill any obligation. In short, if the underlying or ETF is trading below the strike price when the put option expires, the buyer or holder of the put option can and will sell the underlying stock or ETF at the strike price. In this strategy we would be using in this video, we would only sell put options. For a put option sellers, we get to profit when the underlying is above the strike price of our put options. Here is a table showing the annual performance over the last 30 years of SPY, one of the most liquid exchange-traded funds tracking the S&P 500. Out of the 30 years, only 6 years produced negative returns. The rest of the years produced very good returns. So good that the annualized 30 years performance is over 10% per year. No wonder it is not easy to beat this index. The strategy we have here is extremely simple. We would hold SPY shares or similar ETF tracking the S&P 500 as 100% of our portfolio. With that, we would perform as well as the SPY every year. Next, it is to figure out how to generate additional or excess returns using options. At the start of the calendar year, we would sell out-of-the-money put contract on SPY that is 1 year from expiry, and with strike price 25% below the current market price of SPY. If SPY is trading at 600 at the beginning of the year, we would sell a put with a strike of 450. Depending on the volatility that market is trading at, one could expect to collect premium that is slightly above 1% of the current SPY market price. Meaning, if the SPY is trading at 600s right now, selling this put would net us a premium that is above $6 per share of SPY. As for the volume of put options to be sold, we could play around with the degree of risk taken. For this video, we would match half the number of shares of SPY we are holding. This means if we hold 200 shares of SPY, we will sell put options against 100 shares of SPY. Many brokerage accounts allow us to use our main stock holdings as margin or collateral, and would not require us to put up extra margin. In this case, we could use our main shares holding of SPY as margin or collateral for selling the put options. With a ratio of 1:2 of SPY shares that we hold and put options we are selling, many brokerages and their margin structures would be safe from getting liquidated even during the global financial crisis. We would not go through the complex calculations of margin requirements and margin management, as it would vary widely across brokerage accounts. Given the historical annual performance of SPY, we could expect the put options sold to expire worthless in 29 out of the last 30 years. For our portfolio, this would create an outperformance of over half a percentage point over the SPY in those years. In that one rare year in 2008 that the SPY dropped more than 25%, we would be losing 10% of the underlying SPY price if we hold the put options till expiry. But here's what we would do to mitigate that situation. SPY started 2008 at close to 145, which would require us to sell a put with a strike price of 109. On the fateful day of the 6th of October 2008, SPY broke below this level. At this very moment, we would roll the put option. What is rolling? Effectively, we buy back the put option with strike price of 109, expiring in end of 2008, and sell another put option with the strike price that is 5% lower than our previous put option. The new put option we will sell is expiring another year later in end of 2009. The new strike price would be 103. This is also known as defending the put option. In this process of rolling the put option out in time and down in value, we would collect an additional premium of about 1% of the underlying SPY price again. This effectively buys us time for the recovery to come while collecting extra premium along the way. Let's further fast forward the clock to this dark day on 9th March 2009. SPY touches its bottom at 67 since the global financial crisis began. No kidding, but it would be mentally challenging for anyone, even the greatest of investors, to see their SPY shares shed 46% since the start of 2008, or 56% from its peak. Furthermore, the short put position we sold would cost us to lose approximately another 10% of our portfolio value since the start of 2008. As the saying goes, it's always the darkest before the dawn. Fast forward the clock again to the end of 2009. We see SPY recovering to a price of 111. The put contract with a strike price of 103 would expire worthless. Even though we suffered a loss in 2008, our annualized performance over the 2 years in 2008 and 2009 continued to outperform the SPY by about half a percentage point because of the put options we sold and rolled. From there, we can carry on selling yearly put contracts at 25% below the current market price, happily collecting the premium year over year. Now it's clear as day that with this strategy, we could beat the S&P 500 consistently by about half a percentage point annualized. While half a percentage point does not sound like a lot, Over the period of 30 years and with the marvelous power of compounding, this portfolio would be close to 15% larger than a portfolio only invested into SPY. And here we have it, a strategy that not only beat the S&P 500 consistently, but also managed to survive the global financial crisis. The beauty of this strategy is that it is fairly simple and does not require active management. In fact, it is almost equivalent to passive investment. As long as one could understand the very basics of options, he or she could execute it on their own. The real difficulty, however, lies in handling the emotion and fear. This is especially difficult when a big market sell-off occurs, with the put options sold increasing the magnitude of the drawdown. There would be many criticisms to this strategy. As a matter of fact, we would not put this strategy into action on our own, as we find it overly conservative and passive. There are simple tweaks that could be applied to this strategy in terms of the strike price sold, premium collected, or the ratio of put options sold to the SPY shares. And these changes would easily increase the returns of this strategy. This strategy is also overly passive and ignores market trend, selling put options or putting on additional risk, even when market exhibits sign of overheating. Nevertheless, this strategy has shown us that it is not an impossible task for the everyday investor to beat the S&P 500 consistently. And that's it for this strategy. Let us know what you think of this strategy and leave a comment. We hope you enjoyed the content. We would be sharing more on stocks, investing tips, personal finances, market trend, and cool option strategies, many of which we have developed it on our own. Be sure to catch them, and see you again.